Hello there, this is James and you're watching Tixee Live, and a very good afternoon to all of you, and all of you a very happy Thursday. In today's program, I want to talk about some recently released US data and its sort of mixed bag of results and the sort of impact on the market so far from that data. Plus, ask the question, is the gloom bug spreading throughout the market? But before we get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own diligence. And of course, know the risks at hand before entering any trade. With that out the way, let's get started. So, in the last hour and a half or so, we've had some US data, which we spoke a little bit about this morning, and is a little bit of a mixed bag of data. So some good, some not so good, some terrible, not so terrible. It's a mixed bag of results in a nutshell. Okay. First of all, US retail sales. Okay. US retail sales month on month was announced at 0.5% versus 0% expected. So slightly that is better. That is better. But the group retail sales, or as known as the core retail sales, was announced at 0% versus 0.5% expected. That number is the number which goes towards PCE calculations, things like that, which goes towards the GDP. As well as that, US retail sales ex auto, okay, which means, what I mean by ex auto, doesn't include automobiles, cars, okay, so day-to-day stuff, clothing, things we need to purchase. That came in announced at negative 0.3% versus 0.1% expected. So though you had to say the main headline rate, 0.5, was better, that's including car purchases, the overall report or overall announcement of retail sales is not great. Not terrible, but not great either. But what was good news, which came out at the same time, was US initial claims. Now, those of you who are new to trading, initial claims is the number of people in a week previous week who signed on for unemployment benefit for the first time. Okay, and this actually was announced at 213,000 versus the 266,000 expected. So that is actually a very good number. A very good number. Okay, it's a good reading again. So that is not only is a drop off from last week, because actually last week's number, which was 222,000, was revised down to 218,000. So again, we're actually seeing a decrease at the moment of initial claims, which means people are finding work. So the job market is still pretty much very robust. Even so, with this sort of retail sales data, and I think this is a bit of a, like I say, I'll talk about this in a minute. The retail sales was a mixed bag. That initial claims is good. The odds now, the market is pricing in for a 100% basis point rate hike by the Fed on the 21st is down to 21%. Yesterday, the odds were 35% of a 100 basis point rate hike. I think the market pretty much assumes it's going to be 75, like I do. But, like I say, but here's the thing. For the market to have this sort of reaction, okay, basing on retail sales, because the way that the market's sort of looking at it is that the retail sales market, the retail data is showing a little bit of a slowdown in the market, a little bit of a slowdown in some sectors of the retail sector. But here's the thing. What's the main argument for whenever the Fed is put in the corner about whether or not Don't keep Fed in the corner. Every time the Fed is put in the corner about asking the question about recession, okay, their reply and their defense is always this: we have a very robust and growing job market. We have a very strong job market. That's what they keep saying. That's what they keep saying. And the fact of the matter is we had those initial claims that come in lower proves their point in some ways that they do have a robust job market. So even though the market is thinking, okay, the retail sector, the retail data is going to slow the Fed down, I think they're greatly mistaken by that. I really do. I think they're greatly mistaken by that because, for one, the Fed is not going to stop doing what they need to do till they hit their target. They've said this, and the market pretends to listen sometimes, then forgets to listen. And the other thing is the fact that the job market, the job data is still pretty positive and still robust. Again, proves the point that that's their biggest excuse for not being in a recession and being having leg room to do what they want to do. Again, that fuels it. So in my opinion, it's the job data, which is going to, the Fed is still going to be aggressive next week and in November. They're not stopping. They're not going to stop. So again, that's just my opinion. But the market seems to keep doing this, kidding itself. Does seem to keep kidding itself. Anyways, like I say, the mixed data. What was the reaction? Pretty much mixed reaction, to be honest, on the market. Let's have a look at it now. Actually, let's have a quick look at it now. As you can see, this S&P 500 again. It started off quite quiet this morning. Obviously, like I said earlier on, it was keeping its head down. Market sentiment was on a knife's edge, and like I say, it rose a teeny weeny bit on the back of that mixed retail sector data, but really it's still it's under the 4,000 points by a fair margin. Still trading at 3,951 points. So that's fairly, it's tepid, but it's not a real sign of any real development. Nasdaq is the same, 12,123 points. So again, pretty much a tepid response at the moment. If we look at the euro shortly for a short period of time on the back of that retail data did manage to get above parity. It didn't stay there though. It hasn't stayed there. It's currently trading at 0.99967. Like I say, that's the key area for me. 1.0057. That's the level for me. Sterling was pretty much the same. Was trading under the 1.15 handle. Currently trading at 115.05, so just above the 114 handle. And as you can see, had a bit of a boost on the retail data, but then, it again, mixed results, mixed outcome. Dollar yen still fairly sideways at the moment, 143.35. Again, the yen got a bit of strength on that retail data, but not a lot. If you look at the daily, you can see again it's pretty tepid on that as well. And gold, pretty much where we left it this morning, to be honest. Again, had a small reaction. If we look at the 30-minute chart, we can see a little bit more of a movement. As you can see, gain strength again on that retail data. I don't know why it's ignoring the job data. That job data is good. Currently trading $1,686, just under that key area now, which is now a potential resistance if you do get the boost, which is $1,694. So yeah, like I said, I don't know why the market's ignoring that job data, because that job data is pretty impressive. And I've talked about the US initial claims a lot. I usually call it a canary in a coal mine, like an early warning system. It's because when you start seeing a rise in initial claims or claimant count, it's like a lagging indicator. It's indicating to you that something bad is on the horizon. But the fact that it's decreasing is good. It's good. But anyway, more doom and gloom again. More doom and gloom again. As always, there's always doom and gloom. It's not just me. Morgan Stanley predicts the S&P 500 is to drop another 17% in the next 4 months. Don't forget, the S&P is already down this year by 14%. Now, Mike Wilson, one of their chief analysts, a guy I respect a lot because I follow his remarks in many ways. And don't forget, he was a guy, I've said this before when I've spoken about Mr. Wilson before. Whenever I say Mr. Wilson, I feel like I'm in a cartoon. Anyway, I've spoken about Mike Wilson before. He was one of the first people who called who called the drop in the market at the beginning of the year, and he was spot on. He was right. So I do acknowledge a lot of what he says. But this is what he had to say. He said, while acknowledging the poor performance in equities year to date, we do not think the bear market is over if our earning forecasts are correct. And like I say, he has always been pretty bearish, this guy. He really has. But he's been pretty on the money as well. Now, he's also said the analysts in his team expect the S&P 500 to fall by 3,400 points by the end of 2022 and to drop to 3,000 points if the US enters into a recession. So again, very dooming outlook for Morgan Stanley regarding equity market and the other outcome of the stock market. But it's not just them. The gloom bug is spreading. Don't forget, a little while ago, I spoke about Elon Musk and his dire warnings about the state of the economy and his recession fears. Well, that sort of gloom bug is sort of spreading at the moment because very famous billionaire investor, Ray Dalio, okay, very famous. He's a billionaire investor, so he obviously clearly knows his stuff. He believes if the US interest rates rise to 4.5%, don't forget their target by the year's out, okay? The target they're looking for is around 3.75 to 4, according to some Fed members. That's what they're looking for. But he says if it goes to 4.5, Wall Street will crash by 20%. By 20%. So a pretty glooming outlook from a very famous billionaire investor. So yeah, if they push interest rates to 4.5%, Wall Street will crash by 20. That's his opinion. That's what he feels. So again, that's pretty scary stuff. And like I say, the gloom bug does seem to be spreading a little bit. And on other news, something else I want to talk about, what happened today. And we'll look again. I'll pull up on my chart. Adobe, okay, share price dropped dramatically by 13% after it announced their purchase of a company called Figma for $20 billion. Now, Figma is an online design sharing startup company, okay? A sharing startup company. And anyway, the reason why Adobe's share price dropped by 13% on this announcement is because they also announced their earnings forecast for quarter four. And their forecasts for quarter four was announced at 4.52 billion versus 4.58 billion expected. So again, lower than the market was anticipating. But here's the thing. The reason why the share price, and we'll look at that on the chart at the moment, the reason why the share price dropped so dramatically is that investors, when a company announces they're going to purchase a company out of the blue, or, you know, with no sort of big development, it is, look, we're buying it, the investors start to worry about the numbers checking out. For example, if you're doing a $20 billion purchase and your forecast of revenue is dropping, how is it going to affect your future forecast and your future revenue with this big purchase? So this is why their share price is under pressure. Let's have a quick look at them now, actually. Let's pull them up on my chart. If I can, if I press the button. Yay, there we go. Let's have a quick look at Adobe. And this is a big gap. Look at this. Opened with a big gap in the market on the back of this announcement. Closed yesterday, just under $372, and it opened on the open at $318, $318.15. So that's a big drop, a big open with a gap. So this is why the Adobe is currently under pressure. Okay, it's a little bit of a bounce, a little bit of a teeny weeny recovery, but it's be interesting to see how this performs throughout the session. But yeah, that's what happened with Adobe today. Other coming events coming up. Of course, we got UK retail sales tomorrow, EU CPI, and US Michigan consumer sentiment. And don't forget, tomorrow I will be doing a watch along of the EU CPI tomorrow. And I'll be starting at 8:50 a.m. UTC. Don't forget, I'll always go on 10 minutes before the event so we can have a little chat about it, talk about some scenarios, what could potentially happen, and then we watch the event unfold. You know, like I say, hopefully it should be quite a volatile affair. Knowing my luck, I've built it up now. It probably will be, you know, a damp squib, but we'll still watch it. It still should be exciting. And again, of course, this could fuel more Euro bulls thinking that the ECB are going to start being really, really, really aggressive with interest rates. interest rates. So that's going to be a key event. So please come along and join me for that. As the market stands, like I say, the FTSE in the red, negative 0.26%. DAX currently trading negative 0.43%. And Eurostock 50 currently trading negative 0.53%. So yeah, in general, a mixed bag today. Like I say, pretty much the market's carried on with its sentiment from this morning, where it was pretty nervous. Again, I understand it, because obviously what happened on Tuesday was carnage. So I understand why the market is a little bit like it is at the moment. And like I said, that mixed US retail sale data is obviously giving us that the euro is just testing parity again at the moment. The dollar yen, again, still trading 143.38. The sterling just slightly above, just trading at 1.115004. So yeah, again, it's a little bit tepid. I don't know why everybody's focusing on that retail data more than the job data. I really don't, because I think the job data, even though it's only initial claims, and yes, it is a weekly number, whenever anybody's pushed, whenever the Fed is pushed or asked about recession fears and this like that, they they always say how strong their job market is. They always say that, and this is just fueling them more anyway. So anyway, don't forget, you can talk to me anytime you wish, or ask me any questions, or simply say hello if you like, or share with me your own opinion on what you think is happening. Do you think the gloom bug is spreading? We're going to see more doom and gloom as the days persist. Yeah, feel free. I mean, how's your day going? You having a good day? Enjoying, having a good day? I mean, what you're trading at the moment? What positions do you have open in the market at the moment? Or it could be off maybe a topic we discussed this morning, like Bank of Japan. Do you think they finally will intervene and do a currency intervention for the yen? Okay, not a problem. Not a problem. Don't forget, if you think of a question later, you can put it in the comment section, either on Facebook or YouTube. I will see them and I will reply to them next time I go live on air, which will be tomorrow, around about 8 a.m. UTC. Then again at 8:50 a.m. UTC to do the watch along. And again tomorrow at 2 p.m. UTC to do end of the week wrap up and talk about the US session. So please come and join me for that. If there is no questions or no comments, not a problem. Not a problem. Don't forget, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video and you found it useful and you've put up with me, my over-the-top enthusiasm for the markets, which I simply just cannot help because I love the markets, give me one of these. It's nice to know that you like what I do. I can see I've got a couple of likes already, and I really do appreciate that. I really do. And I really appreciate all of you coming along to watch me. I really do. Anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.